and bring up my presentation for today, which isn't exactly a presentation, more so than a worksheet to work out with you guys, because I think if we go through this together, that people will have a better understanding of how this works. So now that we started the recording, let me bring up my little worksheet here. Let's see here. There we go. Kind of explain what we're going to go through here today as far as this risk workshop. Essentially, the question that we're trying to answer here is we're trying to alleviate a lot of students' confusion over what people mean when they mention terms like risk on and risk off, risk aversion and risk appetite. And I think as we go through it and we kind of share different charts and show you how it works, you'll find that's a very simple concept. Oftentimes, risk aversion, risk appetite, risk on, risk off, these are terms that a lot of analysts will use as excuse terms. What I mean by that is markets are going down and they don't have a real reason for it. And you'll often hear analysts come out and say, well, the market's going down today because risk aversion is fueling the market. Well, risk aversion is basically telling you what's happening. It's almost like saying they might as well just say the market's down. Risk, and if the market's going up and they have no reason for it, there's no earnings, it's just bulls are outdoing the bears, demand's exceeding supply, they'll often say, well, risk appetite's fueling the market today. Well, essentially they may as well just say what is driving the market. Well, there's more buyers than sellers. The reason why we use the term risk on and risk off is because it can oftentimes turn into what we call a primary driver of the market. Now, a primary driver is just the overall current. It's just the overall sentiment, if you will, that's driving either markets up or it's driving all the markets down. We can also call this global sentiment. Now, what we're about to go through here is not something that drives the market 100% of the time, meaning markets are not always in these conditions. It's usually during times when global sentiment is driving the market. And we'll get into that here in just a little bit. After we just kind of go through some basics on defining these terms, we'll talk about what the current global sentiment is. So let's start out the top of our worksheet here and say, what is risk on, risk off? Although risk on is the same as risk appetite. Risk on in the market just means that risk appetite is driving market conditions. And all risk appetite is the flow of assets from lower yielding, lower risk investments to higher yielding, higher risk investments. A good example of risk appetite if you are trading with risk appetite, if you buy a stock, if you have a stock account, like with Scottrade or E-Trade or whatever, generally speaking, money is being transferred from your money market. From your money market into your stock purchase. Right now, money markets are yielding about 0.5%, or whatever their yield is right now. So basically, money is transferred from your lower yielding asset, from your money market, into your stock purchase upon settlement. Or if you're trading on margin, it's trading off your money is being transferred from your margin account, where you're paying right now in your margin account, where you're borrowing money from your broker based on your investments. It's being that also has lower yields right now because global yields are pretty low. It's being transferred from that money you're borrowing from your money markets into your stock purchase. So that when you buy a stock, you can essentially say that you have risk appetite, because you're going from your really safe little money market where you're yielding a really low amount of money to going into a stock purchase, which is higher risk, into a higher yielding type of investment that gives you better yield potential. And the same thing goes for the risk off or risk aversion effect. What is risk off or risk aversion? It's the flow of assets from higher yielding, higher risk investments into lower yielding, lower risk investments. And I use the stock market as an example because most people that come into Forex trading have some kind of basic understanding of um, of how the stock market works. So money is transferred from your stock sell, stock liquidation, back into your money market. All right. And liquidate, it's not liquidation. So these are very basic terms. Essentially, we've all traded with risk off, risk on, and risk off before. If you've made any type of investment into something, you expect a higher amount of yield or higher amount of, which also generally comes with a higher amount of risk. You have risk appetite, meaning you think the conditions are prime for you to make better investment returns by going into higher risk investments. When you're trading off risk aversion, you're trading off of fear, essentially. You can almost call these fear and greed, if you will, but those are the two emotions that drive the market. So these are the two things that a lot of people will use as more of excuse terms when markets go up and markets go down. So lower yielding asset examples would be treasury bonds, money markets, low interest rate, or what we call funding currencies. And I'll go through an example of what those are here in just a second. Higher yielding asset examples would be your equities, your commodities, and your high interest rate currencies. So let's go through a quick example of this. And I know this is very basic, but with knowing that you have high yielding, which are risk on investments. High yielding asset would be what we call risk on investments. That means these are the assets that money flows into when people have more risk appetite. And low yielding assets would be called risk off examples, meaning these would be assets that get stronger when risk is coming off of the market and going back into those lower yielding assets. So let's go through some currency examples. An example of how the currency market works in that. You may have remembered this if you've ever gone through something on like the carry trade before. So this just is going through kind of the current interest rates or overnight interest rates, if you will, of all the major central banks. So out of all these currencies, we have the Reserve Bank of Australia, the Federal Reserve. We have all the 8 currencies that we generally follow in class. So Australia, the U.S., Switzerland, Swiss franc, European Central Bank, the Bank of Japan, Reserve Bank of New Zealand, Bank of Canada, and Bank of England. And here's their current interest rates. So which of these currencies up above would you consider to be higher yielding currencies, if you will? If you were to invest in any one of these countries, which ones would you say would give you higher yields when you look at these interest rates right over in here? And we can start from top to bottom. We would probably say, well, Australia, AUD. And I know this is very basic for some of you, but I want people to be able to get this. Why? Because they have when you compare all these interest rates together, they have a 2% interest rate. Let's go to the New Zealand, definitely. New Zealand and ZD, because their interest rate is 2.5%. Next would probably be, well, Bank of Canada. If you had to compare all these interest rates, you'd probably say, okay, well, Bank of Canada, to a lesser extent, Canadian dollar, CAD. So we'll just say 0.5% or above. US, USD, which is yielding right now 0.5%. And Bank of England, which is the Great British Pound. So we'll put that on the next page there. So high yielding, we could also call these risk on currency pairs. So these would be considered risk on or risk appetite pairs, okay, because they're higher yielding investments. So this would also mean These are risk-on currencies. What does this mean? Well, it means they tend to get stronger when global risk sentiment, global, you could also say local risk sentiment, but I want to talk about global risk sentiment. And has more appetite for risk, meaning when global stocks and global equities and commodities are going up, these are the currencies that have tended to get stronger during times when we're in risk-on conditions. Now, define risk-on conditions. Well, when bullish market conditions, during bullish market conditions, when people are buying stocks or buying commodities and people have more risk appetite, these are the currencies that will tend to get stronger when global sentiment is pushing the market up. Global sentiment is essentially the overall current of the global economy. The big mistake that people make is when they ask me the question, well, if China, why the hell is the U.S. stock market going down just because China's going down? Well, we don't live in a localized global marketplace anymore. Everything is, everything from an economic, the economics of how the entire world works is all tied together now. Especially with the major economies, nothing is, nothing works in more of a holistic, in more of a localized environment. It all works in a very global, holistic environment where one economy can certainly affect the other economies around the world. Now, out of all these currencies, which ones would you consider to be lower yielding investments? Like if these were CDs at a bank, you may go for the one, some of these other ones that have 0.5 or 2 or, any of those other currencies. But which ones would you probably stay away from if you were buying like a certificate of depreciation or what we call a certificate of deposit from a bank where you're looking to acquire or get yields on investment? Well, you'd certainly go Swiss National Bank, which is the CHF. You would certainly say Euro. And you would certainly say the Bank of Japan, right? Which is the Japanese yen. Now these are currencies that tend to get stronger on global risk sentiment. I'm going to have to reword this one. Is more risk averse, meaning bearish. Okay. Now these are also called, these three currencies, the Swiss, the Euro, and the Yen, you'll also hear this term whenever you're reading Forex news, and that's a lot of what I try to do here, is try to make it to when you're reading news stories or when you're reading any type of analysis on the markets that you know what some of these terms mean. These are also called funding currencies. Now what this means is I could add to this question right in through here. If you were, let's say you're a bank and you were borrowing money overnight from each in order to invest into the stock market. So if you're a bank wanting to invest, if you're borrowing money from any one of these different countries, let's say you have the option of borrowing money from any one of these countries in order to put that into the stock market, essentially to cover your stock market positions that you want to take in the market the next day. Which of these countries do you think you'd be borrowing from? Well, I certainly, I don't think I'd borrow from New Zealand. They have a 2.5% interest rate. I think if I had to choose between these three, the Swiss National Bank, the European Central Bank, the Bank of Japan, I think I'd rather borrow a negative interest rate. That's pretty good, basically zero. European Central Bank, yeah, I'd certainly borrow from them to go into the stock market, or Bank of Japan. I would certainly borrow at 0.1%. Now, the one that's really interesting here is the Bank of Japan. The funding currencies, JPY is historically the market's funding currency. Since the lost decade in the 90s, because they have historically kept interest rates extremely low for the past almost, let's say, we'll say past 25 years or so. I think it's going on to where, that's historically, how long the yen has been a big borrowing or funding currency. Now, why is all of this important is what you're asking yourself. Why are we going through this whole risk on, risk off environment? Well, think about it this way. In the Forex market, when people have more risk appetite, when markets are going up, this is also the basis for what we call the carry trade. With the leverage that's involved in the Forex market. Let me pull up the MetaTrader charts real quick. Where's CAD yen at? Okay, excuse me, 1 second. We're going to sell one of the CAD yen real quick. Sorry for those of you watching. This is from our live trading class from earlier, so we need to execute a trade. For those of you who listen to the recording, we're going based off of our worksheet from this morning. Pull up my trade manager. My entry on this, it was poking below that support level. It's at a -5 or less. So I'm going to put my stop in at 83.516. I'm sorry, 616, risking 50 pips. And I'm going to put my take profit level at 82.366, which is 75 pips away. And look for some, and as this goes, if in fact this does go in our favor, we'll be looking to trail this down. We're using a 3-bar reversal. You can see, just based on the last couple days, this has a lot of room to retrace back to the downside if oil continues lower. It's going against us, but that trade did execute. So I'll bring that down real quick. Just wanted to make sure we saw that. Actually, I want to go back here to this. And let me bring up something real quick here. You saw all those interest rates on there. Let me pull up just a weekly chart and go back in time for a little bit. Actually, I can go to a monthly chart. And let's see here. There we go. So you look at from like all the way up until 2008, you see here, this is an example of like New Zealand yen, a monthly chart on the New Zealand yen. And you see how here, from 2002 to 2008, how New Zealand yen made a lot of significant higher highs and higher lows. Had a little bit of a dip right in through here, but throughout this time it went up like 4,000 points. It's because during that time, global markets were doing pretty well. So money was flowing out of yen to where people could borrow yen at like 0.25%. And during this time in here, New Zealand's interest rate was upwards of like 8%. So this was also called the carry trade. A lot of a big risk on or risk appetite investment. When, remember, we're talking about global markets. When global markets are doing well is what we call the carry trade, because people can borrow the yen at like a 0.25% interest rate and get a yield on New Zealand at like upwards of, I believe the average was maybe 7.5% or something, to where it was about a 7% differential between the money that you would borrow from one currency to what you would yield into another currency. That's called a risk on or risk appetite investment right in through here. And you can see after 2008 what happened. What happened in 2008? So this was your risk on. This is during a decade when risk appetite was in the market. This was during the mid 2000s. And then in 2008, what happened to the markets? They sold off. They collapsed. What happened? Well, this is a perfect example of risk on and risk off right in through here, because this is risk on when there was risk appetite globally. 2008, when the global financial markets almost collapsed, you see the yen got stronger. And that's because money was flowing into higher yielding investments during this decade and at higher risk, higher yielding investments. And that as markets sold off, they sold out of those higher yielding, high risk investments back into yen. So a lot of it's based on just that flow of investment capital going in and out of these investments. So that's an example of what we would call the carry trade. So that's, that is basically risk on, risk off. Is what is global risk sentiment, if you even think about like right now. We'll get into that here in just a second. So bottom line here. I'm going to ask you a couple of questions. I may be making this harder than it has to be, but let me ask you. And I'll put into terms that you understand. What currencies should increase when the market is bullish? Give me a couple of examples, just based on what we went through. Now, this is really all you need to know. Which currencies? This isn't what drives the market 100% of the time, folks. Sometimes when, there's times when Europe is doing good and US might be doing bad. There's times when this is not the primary driver of the market, but right now it is a primary driver. So I'm asking you this question: which currency should increase? And I'm going to wait for a response from the crowd there under the Q&A. Which currency should increase when the market is bullish based on what we went through up here? This is all you really need to know. When global stocks are going up, when economies are healthy, which currency should increase? Good. New Zealand, Aussie, CAD, US dollar, the pound. Which currencies should increase when the market is bearish? Meaning when the market's selling off, where was that money borrowed from? If I call these funding currencies, I'll rank them actually. JPY, CHF, the JPY being the Japanese yen being one of the most important ones, because of the fact that it's historic, meaning unlike the Swiss and the euro, the Japanese yen has had the most historically low interest rates. So it's the one that you can kind of count on as being a low interest rate currency. I'm going to go to the next page here so we can move on with this, because we're going to go through some visuals here so I can put them onto I got my tablet up here, and I'm looking kind of through. I had a PowerPoint on this, but I prefer to go through it live with you because I think you get it better when it's live. So I'm kind of going through my bullet points, because this is a big deal in the markets right now. Now this whole thing is based on global risk sentiment. Now, if I talk about global risk sentiment, does everybody know what I mean by this? Now, global risk sentiment essentially means that, think of 2008. Okay, 2008 when the financial markets collapsed, that wasn't localized. That wasn't just the financial markets collapsing in the US. That was the entire global financial system almost collapsing. So 2008 was something that was a global impact, a macroeconomic event. All right. So that would be considered global risk, and that's when you have these overlying factors in the market that you cannot distinguish apart from one economy to another. Like everybody's worried about China right now. Everybody's worried about oil right now. So what has been driving? What has been? Let's see the direction. And I'm going to say this of higher yielding assets for the past, we'll call it several months. I'll say global higher yielding assets for the past several months. And what has been there's a lot of underlying primary reasons for that direction. So could we all agree on this? And why? We got oil, China concerns. These have been two of the biggest ones, right? Oil and China concerns. That you can't turn on a financial network anywhere without them blaming the market going down based on oil and concerns of Chinese growth. Okay. So this is where it's going to get interesting for you. And this is where you have to think more on a global scale. All right. I'm going to pull up a chart here. This is called Netdania. I'm glad it's working because I normally can't have a hard time showing it to you. Now, do all four of these charts look relatively the same? And you can feel free to chime in here so that I don't feel like I'm alone. Now, this is just going back. We can look at these from like the first of the year, but do all these charts look relatively the same? You got down and then slight up movement here at the end. You have a down and slight up movement here at the end. Down, that's not even dead cat bounce yet. I guess a slight up movement there at the end here. Down and slight up movement here at the end. Yeah, I guess you could comfortably say that these look relatively the same. They have the same type of movement. This is the Dow Jones, okay? Is this always the case for all these different markets? This is the DAX. This is the German stock market, Germany being a big player. This is oil. This is the Shanghai Stock and Shanghai Stock Exchange, Chinese stock market, going back to the beginning of the year. I guess it would be comfortable for us to say that, is it just the Dow Jones that's been collapsing since the beginning of the year? Is it just the DAX that's been collapsing? Is it just oil that's been collapsing? Is it just China that's been collapsing? No, this is what we consider global risk sentiment. Is this always the case? No. Sometimes the Dow will be going up and the DAX will be going down and crude will be going up and Shanghai will be going sideways. This is not always the case. But in order to get a feel for what's driving market conditions, you kind of got to say, well, is this a local impact event? Meaning, is the U.S. markets, if the U.S. economy has just a bad earnings season, sometimes the Dow Jones can go down and all the other markets are going up. This is not always the case for how the markets trade. However, right now is very similar, and I'm not saying, it's not like 2008 where the financial system is about to collapse. I'm saying this is very similar to 2008 in the fact that there's not just one market that's collapsing. It's just not the Dow. It's just not the DAX. It's just not oil prices. It's just not China. All of these things are pretty much correlating with one another. That's making all these markets give out a global risk. The global risk sentiment, would you call on all four of these charts, would you call this the global risk sentiment bullish or bearish? And I really hope you can get this answer right. Would you consider this bullish or bearish as far as global risk sentiment? You would certainly call it bearish, right? Why? Well, China had a big deal, had a lot to do with it. Oil has had a lot to do with it. And that's really been a lot of what's leading to all these markets kind of going down at the same time. So let's copy and paste that and put that on our chart right now. All right. You can see these are, down, 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 slightly up, I guess they're at the bottom, and down. So I mean, that's basically what the sentiment has been. All right. So as seen above, so the global risk sentiment has been bearish. All right. So now I'm going to go through. Now, knowing what we've gone through so far, and again, this is not a very difficult thing for us to go. If we know that when markets are going up, the higher yielding assets tend to get stronger. When markets are going down, the lower yielding assets are getting stronger. So based on above example, which currencies should be getting stronger or benefiting? So which currencies should be getting stronger? Now, if I know there's some new students in here, but based on markets go up, more risk appetite, currencies tend to get stronger. And when markets go down, more risk averse or lower yielding assets tend to get stronger. So which currencies should be benefiting from these moves up in here? When I say benefiting, I just mean getting stronger, money flow. What currencies should money be flowing into based on this? All right, good. Well, let's see. Now, you're about to see a whole bunch of charts here, and all of them should look relatively the same. But I'm going to switch the charts over here. And let's see what has been going on with one currency here since the beginning of the year. At least I hope it. comes up. I had all these charts all prepped and ready to go here because there's certain points I wanted to make here. There we go. Now we could probably zoom in a little bit on these charts, but let me ask you a question. Do all these charts look relatively the same? Now you're looking at 4, 7, you're looking at 10 different charts on here. Do all of them look like they have pretty much the same general direction? There's some exceptions on here that have little individual points on here, and these are 4-hour charts, just really going back to the same time frame. Some of them are going back a little bit further than others. In fact, we could probably zoom in on some of these. Let's see here. Let's go to the yen. Let's see here. We need to start from November 23rd here. I didn't realize I was going back so far. We'll go back to approximately November 23rd here. Or just, I'm sorry, December. Yeah, some of these have different time frames on them. Just go from 23rd, about the 23rd. There, this one's going back to the 23rd, about June 7th. Third, 23rd, 23rd. All these should be going, all the currency pairs should be going back to approximately November 23rd. There we go. You have to look at kind of just the overall direction of these. But they're all, I mean, if I were to copy and paste this onto the screen, could we all be in agreement that these all look the same? I mean, these all have downward momentum followed by a little bit of an uptick here. See, this one's not going back as far. We need to go back a little bit farther there. There we go. Go back a little farther here on our oil prices. I'm trying to get these all to where, at least to where they're reflecting like November. There we go. This kind of takes us back to about the same time frame on all these charts. Now, these are all the yen pairs. This is dollar yen, pound yen, Aussie yen, Canadian yen, Euro yen, New Zealand yen, Swiss yen. This is the DAX. This is the Dow. This is crude oil right down in here. I didn't have Shanghai on here because you can only put up like 8 charts or up to 10 charts at a time when you're doing this. But when you look at all of these different investments, these are all flowing in the same direction. So if I say to you, which currency has benefited the most from the market turning down, the yen is the quote currency in all of these pairs, okay? That means when these pairs are going down, it means the base currency, which is the dollar, pound, Aussie, New Zealand, Euro, CAD, Swiss, are getting weaker, and the quote currency, which in this case would be, zoom out a bit on that one. There we go. Move that over just a bit. There we go. And the quote currency, which is the yen, is getting stronger on all these. So as DAX has fallen, as the Dow has fallen, as crude has fallen, you can clearly see that the yen has gotten much stronger. I should have just kept these all the same because they are pretty much all in line with each other now going back to November. Yes, there we go. So yen strong, yen strong, yen strong, yen strong. This is the yen strong. This is the yen strong. This is the yen stronger. This is the DAX getting crushed, the Dow getting crushed, and crude oil getting crushed here to the downside. Now, why is this important to know? Well, most of you are still stuck on the fact, well, how do we trade it? Well, when you know what's part of Forex trading, folks, is knowing what's driving the market. The market has not been driven by anything other than so far in the Forex market, the yen has been really one of the most primary drivers of the market. Why? Because this is happening on a global scale right now. Markets have been tanking. China, crude oil has been going down. All this has been contributing to massive sell-offs in the global stock markets. Now remember, in your mind, remember, this is not always the case. Sometimes, like I said, the Dow will be going up while the DAX goes down. I mean, sometimes these economies do float out there on their own, and individual economies get stronger and weaker. And that's when it's a little bit more clear. That's when you can kind of trade, euro strength or dollar strength versus one another versus one economy strength to another. But during times like these, it's important to know what's driving the market. Because if you're sitting there looking at the yen pairs, I know Steven had asked me this on an email, how do I differentiate between a trending move and a retracement, a directional move and a retracement? Right now, if you were to look at all the yen pairs on here, you would probably say that these are all pretty much just retracements. It doesn't seem like there's a huge amount that's telling you that any of this direction is going to turn around. Which is why in class, when we do our live trading, we say, okay, we're going to trade risk off. We're going to trade bearish in the market today, which means that we're going short on a lot of these yen pairs. The ones that tend to get the strongest and weakest are certainly the commodity currencies versus the yen, those being the higher yielding assets, are the ones that tend to drop the most when this type of deal happens. But, this is all about knowing what's driving the market. If you see a technical pattern to go long on one of the yen pairs, but you don't know the fact that, and if you do not know what is driving the market, you're leaving out a big part of the equation. And that's what really just going through something like this is based on. It's based on you knowing what's driving the market. These are all down. These are all coming down. Why? Because the global markets have been shifting to the downside. Have all of them? No, but these are kind of the major ones that kind of all flow in tandem with one another, all flowing down here. Whoa. There we go. And here, let me put that up there. So the yen has been getting stronger. The euro has actually been getting a little bit stronger, as has the Swiss versus the dollar recently, since the beginning of the year. So these are the JPY pairs versus Dow, DAX, and oil. Just showing you a picture of how this is working out. So let me get back to my original point, since I do have all these charts on here. There's so many more technical traders in the market that people that trade blind. It's the state of where we're at right now as in the world is, people that are more technical, or they rely on automated trading systems to when the technicals are ripe to go long on dollar yen or any of the yen pairs. They go long on the yen, and then they'll get stopped out because the overall prevailing trend on the yen has been down. They'll get stopped out, and they'll say to themselves, well, why did it get stopped out? And they have no idea that this relationship exists. They have no idea that they're looking for an excuse why, and they'll probably be sitting there watching CNBC or something, and they'll see that the markets are up. The markets are up at 100 points or 200 points, and that oil's up. But yet they're still, trading off their automated trading systems or whatnot, wondering why they got stopped out on their long dollar yen position or whatnot, or their long euro yen position, and they're wondering, well, why did I get stopped out? Well, you got stopped out because the market sentiment shifted that day and global markets increased in value. people don't like to hear this because they don't want to know about the synergy that exists between all markets. But when global risk sentiment is driving the market, generally this is the way markets are going to look. You need to know that, when global risk sentiment is driving the market to the downside, that it's generally going to pull, the overall current of the market down based on these higher yielding versus lower yielding currencies, if that makes sense. So how do you trade it? You do have to have kind of a feel for what's happening globally. You have to have a feel for what's driving the market globally. And that's why it's so important to know these things. If you're bullish on the stock market, you probably would not want to be shorting the yen pairs, because you're going in opposite directions, if you catch my drift. So let me the whole point of this is not necessarily how we trade it. It is basically knowing what's affecting the markets. Like you'll see me hesitate sometimes to go short the euro dollar when I see that the market is going down, because the euro is also one of those funding currencies. The euro is one of those currencies that will sometimes, that will often go up as the overall market collapses. So what we've been doing lately is we've been trading more of what we call risk off. So when we're trading more risk off, we are looking to short like CAD yen into what we look at as a retracement right now. Could that change if we start to get more recovery in the U.S., in the global economic environment? Absolutely. But whenever I put on our trading sheet and I say we're trading risk off, here I have an example of our trading sheet from this morning here. When we say risk off, JPY strength, when we sell into CAD yen, we know exactly why we're selling into CAD yen. When we're breaking through that support level, we know that in order for that CAD yen pair, in order for it to come to be profitable for us, we know that we're probably going to have to see the markets go down. If we're long on something like the CAD yen pair, then we'd probably have to see the markets go up. It's not necessarily this whole webinar here is not necessarily, well, how do we trade it? How do we trade it? Well, you short yen pairs when global markets are in fear mode, which they have been, which we've had a lot of success with, and you would go long when you see recoveries start to happen. The individual strategies we go over in our live trading class every day, but you still get questions from people as far as why, what is risk on? What is risk off? What do you mean by this? Well, it's the characteristic of the market where that when markets go down, you can look for certain trades. When global markets and global risk sentiment is going up, you can look for other certain types of trades. Is it a condition of the market permanently? 100% of the time? No. Like I said, sometimes the Forex market is a local market. Sometimes it is driven off, if the U.S. economy is doing well and the Dow is going up because of it, and the Euro economy is doing crappy and the Euro is going down because of it, you can short the Euro dollar. Short the Euro, go long the U.S. dollar. So that's more of a local example. But it is certainly an example of how the markets work and what drives market direction in one direction or the other. So instead of thinking how we trade it, I just want you to be able to define these terms, and that's really the point of this whole workshop. So I'll put a kind of a bottom line on this, and I hope it's been here. Let me write this out real quick. As you can see above, as global markets have gone down, so have all the yen pairs. And why? Because bearish is equal to risk off, or risk aversion. risk off is driving the market, the yen gets stronger. And I should say on here the global market. And the yen is that historical lower yielding asset or funding currency. The bottom line I'm going to write on here as far as the purpose of this. If I say we are trading an instrument based on, and I don't always say this, if you can answer this question, if I say we are trading an instrument based on risk on, what do I mean? It means we are going long a currency because we expect I'll just put global stock markets to go which direction? We're looking for it to be bullish. And if I say we are trading an instrument based on risk off, what do I mean? It means we're going long a currency because we expect, it doesn't have to be global stocks or global, we are bearish. And on top of this, if you write, oh, good, thank you, Stephen. And the other reason why I do this workshop is because of this. You see this all the time when people read analyst comments. And I put this in the little advertisement for this class. And a lot of this is just knowledge is power. If you read a news story and see this, if you can answer this question. If you say yen strong, if you see yen strong today based on risk aversion, this is why I have classes like this. This really has nothing to do with let's pick a trade. This is more based on you having the knowledge of knowing what things mean when you read them. If you read a news story, this is where a lot of the questions come to me, and people always assume that a lot of like retail traders and other people that are maybe even doctors and lawyers, that they're not economists. They have no idea. A lot of people do not know what this means. Well, why is the yen, the yen is strong today based on risk aversion. If you read that, well, you know what that means. It means that the yen is strong based on risk off. And what they're trying to tell you when analysts make these types of statements is they're saying the yen is strong today because the markets are selling off and that money is flowing into the yen. And so the yen pairs are getting stronger. That means that there's no news out really there's no news on the yen. There's no reason. Bank of Japan didn't make any type of economic announcement that caused the yen to get strong. The yen is getting strong based on this money, this investment flow from higher yielding assets to lower yielding assets. And that is really the whole basis for what we're talking about today. And that's what, what the whole point is for you to know that when those statements are made, it's important for you to know what they mean. And that's why I thought I'd go through this with you. I've gone through it with a lot of my students in NeuroFX quite a bit, but it's important for you to know, what, you don't need, there's so many factors that can affect currency markets, stock markets at any given time. And this is really more of a holistic factor that doesn't necessarily drive all the currencies in one direction or the other all the time, but it's certainly a driving force in the markets right now. And markets are constantly changing. And I appreciate those of you that were chiming in on that. Do bond price yields confirm sentiment? Bond yields can, and let's see here, they can be a driving force. And only if yield curves, like if they go to an inverted yield curve, sometimes they're not as trusting. But yeah, bond yields, like if you look at 10-year treasury yields here in the US, same type of correlation tends to exist based on that whole risk on, risk off sentiment. So yeah, absolutely, yields can confirm that. It's more of just looking at how things are working in tandem. When we have things like what are happening from the beginning of the year, sometimes you have to look a little bit more. Like right now, it's not necessary. Stephen, that's a great question, by the way. It's not necessary right now to kind of look that in depth into yields, like individual bond yields and such, because people do that. People that are especially like bond traders and people that really are big yield type of investors, they'll go further into that mode. But right now, like from the beginning of the year, it hasn't been necessary to do that, if that makes sense, because it's rather obvious what's driving the markets down right now. Oil prices, oil concerns, what's happening in China. These are things that are kind of more obvious. You don't have to look as close into them. But yeah, there are certain times in the market where there's up and down movements where you do have to kind of take the extra step of looking at individual yields and such. But they can be a confirming factor when you don't see as much obvious bearish tones in the market on other more obvious investments, if that makes sense. I'm going to go ahead here. I know my hour's up, but if you understood this at all, as far as, let me go here. Make sure that this thing is saving for me. There we go. I need to take this down so I can share it with you on the handouts. All right, let's check and see what CAD yen's doing right now. I know it's hovering right off our entry point, so it's not, it's still hovering right in there. Don't really have any other trades right now as far as, we're still waiting for Draghi to come out at 1 o'clock. That might give us something on the euro. Euros, it topped out there at 108.45. We're still looking for it to break through that 108 level on the euro at post 1 o'clock. If it can break down below there, we may be for a bigger move on the euro to the downside. But the euro also, the thing that would concern me about the CAD yen pair over here after 1 o'clock is if Draghi comes out and he's dovish and he brings that euro down, it's probably going to bring CAD yen back up, meaning stocks will probably have to recover in order for the euro dollar to go down. You see, markets are down today. CAD yen's down, New Zealand yen's down, and euro dollar's up. So euro dollar's trading risk on, if that makes sense. It means the euro's getting, the euro dollar's trading risk off. The euro dollar's trading risk off, meaning it's getting stronger as the markets have gone down. Wow, I almost confused you there. The euro dollar is trading. I saw it going up, so I said on. Euro dollar is going up based on risk off right now. Why euro? Just like we said, it's a funding currency. That's one of the reasons why the euro has been going up. So we'll have to watch Draghi's comments there, because if this comes down and breaks 108, it will probably bring CAD yen back to the upside, because markets would have to recover after 1 o'clock. But at least we have something in our pocket as far as a alternative trade should the markets bounce back. If not, this CAD yen, if the markets just continue tumbling, CAD yen will probably continue tumbling down, and euros will continue going to the upside. So we're still looking at that 108 level from the class this morning. I'm going to stop sharing my screen just so I can get this recording transferred over. I wanted to mention something real quick with you. That handout should be uploading. There we go. There's nothing more powerful as a trader than when you can, this may seem like cocktail talk, but then when you can distinguish what's driving market conditions. And if you don't believe me, go to like the World Forex Trading Expo or something like that. And if you went to it right now, you would be surprised of how many people say they're expert Forex traders but can't answer the most simple questions regarding Forex trading. And I know this because I get it all the time from people who call themselves professionals when they'll say, I just got it last week, when they say, hey, I got an email from a guy who's he is very technical. He's very much an algorithmic, like, price action trader, to where he asked me, hey, do you have any idea why all the yen pairs are going down? And there's nothing more liberating when you're a trader, when you can answer the question and say, yeah, haven't you been watching the stock market? Haven't you been watching global stocks? Haven't you been watching, what's been happening with the DAX and all these markets are going down. China's going down. Yeah, the yen pairs have been going down based on risk aversion. And then you may have to send them the recording for this class, because that's exactly why. And that's really where you want to be as a Forex trader. We're going to win and lose trades based on these overlying market factors, if you will. But knowing the reasons why these moves are happening is such an important piece to trading. So those will be kind of my parting words here. I'm going to go ahead and stop the recording. Thanks for listening to this for an hour. I know it wasn't really trade focused, but hopefully it was better at defining what this whole risk on, risk off sentiment means in the market. So with that being said, I am going to go ahead and stop the recording and sign off here for the day, because I've been talking for about 2 hours straight. And thank you, Stephen. I appreciate that, buddy. And I will chat at everybody later. Thanks for coming in today, and have a good one, everybody. Happy trading, and some of y'all talk to here in the morning in the Nuri FX. So thanks for coming in, everybody. Bye-bye.